Welcome to the Daily Update, where I'll go over the action in the market for Monday, February 5th, and then we'll see how things look for Tuesday, February 6th. We had a down day. On the negative side, we saw prices go quite a bit lower. On the positive side, they hit that low pretty early in the session and then were able to bounce up off of that. So we're still looking positive overall, but we are seeing some weakness potentially developing. We're seeing some negative divergences. Now, a good solid update could clear out a lot of those issues, but for right now, they've been building over the last few trading sessions, and we have to heed those and just be aware of them to see if that's going to lead to more selling. So let's go back and talk about what happened. Right at the open, we had a lower open, and prices fell below the daily pivot at 49.47. And then we found support at S1 at 49.19. That was the low of the day. As we went on, prices rebounded back up to the daily pivot, up to the unchanged level, which acted as overhead resistance. And then we fell back and closed slightly below the daily pivot. We were down 0.32% on above average volume. As I said, we are still positive with our technicals, but as always, there are things to be aware of that are presenting some concerns. It doesn't mean that everything's shifting because we have to go with price. That's the ultimate indicator of what's going on here. At the same time, we can get some clues by looking at these other things to see if weakness is starting to come in. But there's also some strong sides that we can still hang on to as well. And it's about inflation, interest rates, growth concerns. As I've been saying all along, a lot of the negative impetus for Monday's session came when Chairperson Powell spoke on 60 Minutes and pretty much reiterated what he had stated last week, now more in a prime time type of situation. And that kind of took some of the wind out of the sails. Not that the market didn't already know that. It kind of was poised to go down anyway. We're also keeping an eye on the different geopolitical events, which seem to be escalating, but don't seem to have much of an impact on what's going on in the stock market. Some comments that we can make. The rebounds that we saw came later in the day with the mega caps, and that's what held the indexes together. They had losses earlier in the session. They came back and actually repaired a lot of that. Rising interest rates, that's what was really putting some pressure on stocks. Now the last couple of sessions, we've seen interest rates really jump as they take this March idea off the table, and now they're pushing it out into the future that there's going to be some rate cuts. And Friday's employment report still is being interpreted as being quite strong. And so now the market's kind of like, wait a minute here. We don't like this really strong economic data. Is that going to continue? If that's the case, then interest rates may go back up. We're also continuing to see a bit of a rebound in the dollar, and both of those together did put some pressure on stocks. And this is what I said about Jerome Powell being on 60 Minutes. And he said that the Fed needs to see more evidence that inflation is moving sustainably. I said that last time too, down to its 2% target before lowering rates. That's what the Fed's trying to get to. It's 2%, and we're still above that. We're going in the right direction as far as the reports that we get, but it's not there enough. They want to see this continue on before they're going to have more confidence in actually cutting rates. On a short-term basis, our list is getting a bit shorter now. We still have the Williams percent R, the CCI 14 and 20, and the stochastics, and I'll show you these charts. Intermediate term, our list is also getting a bit shorter. We have the PMO oscillator, which is now starting to turn more negative. It's crossing below its moving average, but it's still extreme positive, as are all of our different oscillators that we've been following. The Sean trend meter is getting even more extreme. We still have the bullish percent index for the NASDAQ 100. That's still at a pretty high level. The boom indicator based on 50 periods. The 20 period has now dropped off. And then the new high, new low study for the S&P based on 10 periods. This is the scenario that we've been dealing with now and just modifying it. It's been about the same for the last couple of months, 2-3 months at least, that the Fed could in fact be done raising rates and even entertain the idea of cutting rates into the future. They're taking March pretty much off the table. Now they're looking at the meeting after that, which would be in May. The dollar was up and interest rates were also up. we've climbed quite a bit. We were under 4% just 3 trading sessions ago. Now we're jumping up to 4.16% for the 10-year yield. The 10 to the 2 and the 10 to the 3 month, those yield curves still remain inverted. And this is interesting. We actually ticked up with sentiment, and we're getting near that extreme positive reading. Even though a lot of the day was spent negative, we saw sentiment actually go up from 67, where it closed at 73. When we get at 75, that's when we start to get extreme positive. And our trend is still positive. The green line's on top, but it is coming down. We're also dropping below the moving averages. That's suggesting that the trend is weakening. Our bias is mixed because we had the solid up day on Friday and then the down day on Monday. I'm kind of taking that as a mixed when taken together. And we're still positive with our momentum. And that looks back over the last 2, 3, 4, 5 trading days and kind of puts them together. And I state this every once in a while. This is the one area of the video where I actually interject my own opinion on things when I come up with the bias and the momentum. I try to let the charts do all the talking, and then we kind of can reach a conclusion by seeing a consensus of what things are telling us overall. The economic reports that came out, we just had the S&P Global U.S. Services PMI, the final reading. It was at 52.5. The takeaway from this is that we were above 50. And so we are showing some expansion economically. And then the big one in Monday's session was the ISM PMI that came out. It's also above 50 at 53.4, much more than the 52 they had expected. Last time it came in at 50.5. And we had the non-manufacturing because the U.S. is switching from being a manufacturing economy over to a services economy. So services tends to grow more than the manufacturing part of the economy. And this is still showing some strength. And then here's a chart to show you the ISM indexes. The total here is going back up and is above 50. So that's still suggesting good economic growth, or at least strength for right now. What could be a little bit concerning is the yellow line here. The prices, they really started to shoot back up. Then some Isabel Net blog charts, just a couple to show you here. This just says that the largest tech stocks have outperformed modestly over 2 years. And then this is rating them with how they've been doing. And then the rest of the companies, the dark blue area, these are the Magnificent Seven. Let's see, 2, 4, 6, 2, 4, 6, 7. Yeah, there's 7 in here. And how they've been outperforming the rest of the market and all the other markets that make up the S&P. That's why if you're in these particular investments or trades, you're probably seeing better returns than if you were in some of these other stocks that tend to be lagging. And then looking at the Magnificent Seven again, this is their PE ratio. And this is fairly common. We stick with that 10, 15, 20 scale with static PE numbers. Well, it's very common for tech stocks and the darlings of the day to trade even higher than what the normal PE ratio is. And they're up at 30 right now. But they've been a lot higher than that before. And so it's very common to see really high multiples, is what we call these, when these are the stocks that everybody seems to like. And then looking here at the other forward PE ratio, we're seeing it at about 20 or so. And I usually go over this in the weekly video. And then if you take out all the other stocks, and there's more than 500 stocks, but they subtract 7, so they come up with 493. We're at about 18. So we're more fairly priced, not necessarily expensive, at least according to this chart. Here's our intraday chart where we didn't really gap from Friday's close to Monday's open, but we did head down pretty quickly down below the daily pivot. We came all the way down to S1, and that is where the low was set. We were able to bounce up off of that, come back up to the daily pivot, which acted as resistance for quite a while. We got almost up to the unchanged level, which again acts as resistance. We fell back down and ended up closing slightly below the daily pivot. Here's our intraday chart. Not a real big change from Friday's close to when the futures started trading Sunday afternoon or evening. We came down just a little bit here, but it's not a big move that we're seeing. And then we pretty much held on to this, and we weren't negative. We're down below this dashed line. And then things turned more negative when the cash market opened. You see the recovery, and we're pretty much flat going into the initial overnight session. This is one of the positive areas. We're seeing the blue line above the red line now. That means that growth was up where value ended up being down on an intraday basis. Here's our intraday growth to value ratio, which is also showing some improvement here. So this is rather encouraging and a positive thing that we can look at. And I wanted to show this too, where the small caps growth to value ratio, it's breaking out of its sideways range that it's been in for almost a year now. And that could be positive for the small caps. We're not really seeing that in the index. You notice the index up here, it was actually down. But to see growth start to break out like this could be positive. And one of the other areas that has been stronger that we've been kind of hanging on to is mid-cap growth versus value. It didn't see quite the big breakout, but it is looking much more positive, even though the index has been going sideways lately. So this is another positive thing that we can hang on to for right now. Our end of day chart shows where growth was up, value was down quite a bit. When we look at the large caps, it was down for the mid caps, but down less. It was also down for the small caps, but down less. This middle area in here, these are the ETFs. That's why I skip over the core areas for these particular parts of the market. And here's our end of day chart. This is still showing some improvement. When we look at growth to value for the S&P, this is continuing to go up. We have not surpassed this previous high yet, but we are at least heading in the right direction. On the other hand, we are still coming off of a recent death cross with the trend of this ratio. Then keeping an eye on discretionary, this is a concern now where we've been going up with the S&P. We look at the ratio between discretionary and staples down below, and it's chopping sideways now. We want to see this going up, and it's just not doing that. Keeping an eye on our trend, we're still below the moving average with the ADX. So that suggests the trend is weakening, but we're still above 20. So we are still in a trending environment. The green line, even though it's coming down, is still on top. So we would still default to positive. Short term, we're also pretty much right on top of the moving average. The green line's on top and also declining. We are still above average with volume. We came down a little bit here, but overall, the last number of trading sessions have seen pretty healthy volume. Then looking at sentiment, this is from Isabel Net. This is also, it's a couple days old now, but this is more of a composite type of index that they put together where they take the AAII, that's the American Association of Individual Investors, Investors Intelligence, the bullish percent, the put call ratio, the active asset managers, and the VIX, and they cram it all together. And when you take them all as a total, we are over into an extreme positive reading right now, where based on the charts that we look at, we're just right on the border between the yellow area and the red area. Then here's another fear gauge that we follow. This is called the ulcer index. The more it goes up, the more you're freaking out because most people lose money when the market goes down. It ticked down just a little bit in Monday's session. Then we look at the VIX, which declined with the line chart as well as the bar chart, which we still had a down day, and to see the VIX decline is kind of interesting. We look at the VIX of the VIX, where it's also showing that the volatility of the VIX continues to decline as well. So this is looking a little more positive when we look at just inside the VIX. Then the equity put call ratio. This is turning back a little more negative now. We actually ticked up with the equity put call ratio, meaning that there were more puts purchased than calls. And this is the big one that we tend to follow, is the 5 period of the equity put call ratio. It is starting to turn back up. Now it's just a tick up, and it could always turn and go back down. But if this continues to go up, that would be more negative for stocks. This is another chart that we don't look at all that often, but we have been really focusing on it the last couple of videos. This is the correlation between the VIX and the S&P, where we're still above this dashed line. We're getting to an extreme reading. That is typically negative for the market. Now what we're waiting to see is this going to keep going up and top out at some point and then start to come down? And then I've tried to mark on the chart when other times we've had extreme readings, and then you can look at the bottom to see what did the S&P do after that. And a lot of times it produced some kind of a short to even intermediate term pullback. We're also keeping an eye on the SKU index. It continues to go up, and the market is anticipating some kind of a big move. It doesn't necessarily help us determine if it's going to be an up move or a down move. because we see both when you see the areas that I've marked on the S&P up here, but the market is building up for some kind of a big move. Is it going to happen in Tuesday's session? Not well, anything can happen, but we don't have any economic reports coming out. So there's really nothing for the market to key off of. It's just going to have to be market action itself if things end up moving in a big way. Our advanced decline line studies, we turned down just a little bit based on price as well as volume, and we're seeing a little bit of a negative divergence as volume is going down with a little bit more enthusiasm than price is, but we're still positive since we're above the moving averages. And we're seeing just a little bit of an expansion of the new lows. On a down day, it's probably pretty common to see that, but we're still seeing where there's more new highs. We're turning down just a little bit with our 5 period. And now, after going up pretty solid, we're starting to roll over with our 10 period moving average. We're still positive, even though we're declining here with the advanced decline ratio. Accumulation distribution, this is more positive. It's continuing to go up and it's above the advancing moving average. So this is suggesting that the smart money is still buying. The Chaikin money flow, also another smart money indicator, is continuing to show some improvement, suggesting the smart money is coming in. The Chaikin oscillator also is continuing to look more positive. And then we saw a decline, pretty hefty decline with the NYSE advanced decline line. And then the black bar chart here is the S&P 500. The trend lines that I have on here are the trend of the advanced decline line. So it has been showing some improvement, enough to give us a golden cross. And it's really not in danger of crossing back anytime soon. Then we were keeping an eye on the cumulative advanced decline line for the NYSE. It really dropped off. It was down a little bit on Friday. It saw a lot more weakness in Monday's session. We're also rolling back over and turning down slightly with the NYSE regular advanced decline line. So when we look at all of our advanced decline lines across multiple indexes, we're coming back down to the moving average with the NYSE common stock. We're rolling over, but still not showing a lot of weakness yet with the S&P. We're rolling over, coming close to the moving average with the mid caps, and we're crossing below the moving average now with the small caps. Here's the daily chart. We're still looking okay here, and we're not able to close up above these pivot points here, which could be acting as overhead resistance. And on the bottom, we were just barely above the moving average with volume. And we turned down just a little bit with the Williams percent R, but we are still extreme positive. We're also extreme with the CCI 14 and the CCI 20. Not big readings, but they're still extreme nonetheless. We came down with our 20, 50, and 200 period moving average study. And we came down just a little bit, but we're still above the midpoint with the force index. And we're still extreme when we look at the stochastics in the short term, intermediate term, and the long term. And we're no longer extreme with our standard deviations chart. We're just a little bit underside of the border between +2 and +3. When we get up to +3, that's when we're extreme. Now that we're getting down into +2, that's no longer as extreme as it was. Intermediate term, we tick down barely here with the balance of power, but this is still positive. We're still positive with the go, no-go system with the darker blue bars. We're still looking okay here with the highest high value. We're hugging the blue line, which is the highest high value, and we're above an advancing midpoint. TTM squeeze, little bit of a concern here. It's going from the lighter shade of blue, which is positive, to a darker shade of blue, which is positive, but a little bit of a warning sign. With our ease of movement, we're still continuing to go up, so that is positive. The Erin was pretty much flat from Friday's session, where the green line is on top, that measures buyers. The red line is on bottom, that measures sellers. The difference between the two is what the oscillator calculates, and we're not really seeing much of a change there. This is one of the negative divergences that I latched onto for Monday's video, and we're still seeing that, where the S&P has really been going up, but we've been seeing a real decline with the McClellan oscillator for the S&P, and it's actually continuing to decline. We could come down here and get a negative, extreme negative reading, but we're not quite there yet. So we continue to decline based on price, and we're turning back down based on volume. That's another negative divergence. You can see where we were going up with price, we've been coming down, when we've been going up with the S&P, we've been coming down based on price. We've also been declining based on volume. This is a longer term negative divergence that we're now starting to take notice of, or it's been there all along. I'm just trying to point it out more. We're also looking a bit more negative with our McClellan oscillator for the NYSE. It's below zero and continuing to decline as the S&P had been going up. So we are starting to turn back down with our NYSE summation index based on price, and we're actually falling a little bit faster based on volume. This is also another warning sign. We're dropping below zero with the Swenlin trading oscillator based on price and volume. And we're just kind of chopping around after being kind of extreme positive here with the PMO. We're rolling back over based on price, and we're still on top of the moving average based on volume. We don't have anything extreme here anymore for the first time in a month or so, where we're seeing some weakness here with the PMOs that are rising. We're also turning back down with the buy signals. And after being extreme for the whole month of December and pretty much January, we're starting to drop below this extreme positive reading with the PMOs that are above zero. We switched from being positive over to neutral for the Elders Impulse system for the S&P. We're still positive with the parabolic SCR. We want to watch that. It's getting near that point. I've been using this indicator for many decades, and if we see a real drop here, that could very easily put a dot on top. The slope is coming back down to its moving average and is still extreme positive. The MACD is actually looking a little more positive. It's turning up above its moving average. So here are our short-term oscillators, the slope and TSI. We're flat with the TSI. We're trying to turn up with the MACD. We're right on the moving average with the PMO. We're just a little bit below the moving average with the PPO, and we're right on top with the tricks, and we're looking positive with the KST. So we're getting a mixed picture across the different time frames on this chart, but we're still above all of the moving averages here in our moving average tree. We continue to decline with the bullish percent index. It had gone extreme positive. It's coming down. Now it's dropped more decisive below 70. And not so much in Monday session, but we had a solid up day on Friday, and this continued to decline, and that was a big warning sign. The NYSE bullish percent index is also declining, but it's still above 50. And we're also declining with the NASDAQ 100 bullish percent index, and we have not dropped below 70 yet. So this is still extreme positive. The money flow is pretty much flattening out, but it's still positive. We ticked down just a little bit with the ultimate oscillator, but we're still above 50. The vortex is still showing the green line going up, so that is positive. And we are turning down a little bit with the RSI based on 14 as well as 9 periods, and we didn't get extreme positive there. We ticked down a little bit with on-balance volume, but we're still above an advancing moving average. And we're turning down with our 200-period moving average study, and we're really going down a lot faster now with our 50-period moving average study. So when I talk about weakness developing, these are the kinds of things that I'm talking about. We could have a solid up day that could take care of this, or a solid couple of up days. But right now, we just have to go with what we see. The Copic curve continues to be positive. The Sean trend meter actually ticked up and is looking quite extreme positive. We're no longer extreme with the boom indicator. This measures how far away is the closing price of the S&P from its 20-period moving average. When it gets really far away, it has a tendency to bounce back. The 20 period was extreme. Now it's fallen back a bit. We're still extreme with the 50, and we're still looking more positive with the 200 period. Our different charts, the Heiken Ashi, though, it's still positive. We're turning down with the Kegi. We're black. That's positive, but since we're pointing down, that's black with a negative bias. And we're still positive with the Renko chart. We're still positive with the 3-line break. And we're no longer extreme for the first time in quite a while now. The 150 and 200, they're falling below these extreme positive readings. We're still seeing where the S&P itself is having more of a tendency to outperform the equal weight or the rest of the broad market there. That's why we're seeing the red line actually coming down more. And we saw our ratio really go up. That just means the mega caps outperformed the rest of the equal weight index. The Dow is still pretty much chopping sideways, didn't set a new all-time high, but it was down 0.71%, but not an awful lot of damage there. We switched back over to neutral, though, with the diamonds when looking at the Elders Impulse system. We're coming up here to this R1 level, and now we're starting to come down. But if you look at this bar, it might be a little hard to see. We actually closed near the high end of this for the NASDAQ, so that could be somewhat positive. Here we are with the Fibonacci retracement levels. We continue to be in no man's land. We haven't quite exceeded these previous highs. So we're not getting anything from the Fibonacci levels. What we're looking at right now are just the bars themselves. And the NASDAQ 100 also did a pretty good job of repairing some damage and closing near the high for the session. That could be positive. And we continue to be positive with the QQQs when looking at the Elder's Impulse system. It's hard to read momentum right now. We're still right on top of the moving average. It had gone negative. It tried to show some improvement. Now it's right back on top of the moving average again. The small caps, they were down, and they've actually now dropped below their 50-day moving average. And they continue to be negative with the Elder's Impulse system when looking at the small caps. We're also dropping below the 50-period moving average when looking at the Russell 2000 small caps. So we hit this resistance area. We got above it for a few days, and now we're coming right back down. The RSI is below 50 and declining, and the MACD, the momentum, is also turning more negative. And we're right on the pivot point now with the mid cap. So this is holding up a little bit better, but we've switched over from being positive to negative now with the Elder's Impulse system when looking at the mid caps. We didn't set a new high with the FANG index, but it closed well up off of its low. The financial sector was down, but still tends to be positive overall. This is the area we're keeping an eye on to see if there's more banking information that's going to hit the markets. The dollar continues to go up, which is also pressuring stocks, even though it's still in a longer-term downtrend. We were really up. Look at over these last 3 trading sessions. We were down at 3.85%, and we've climbed all the way up over 4.15% just in a really short period of time based on the 10-year yield. So we're starting to really come down based on price. And then just to look at our growth to value ratios, the Qs are showing a bit of an improvement now against the S&P. We turned back down with discretionary to S&P. We were seeing a little bit of a hope there as this was coming back up, but we're still below a declining moving average. This is more positive when we see large cap growth outperforming large cap value. And with the large caps, we're seeing some improvement. The mid caps and the small caps actually made more of a pronounced improvement. So we're seeing some improvement with growth to value kind of across the board right now. We're still extreme positive with the 10-day average of the S&P 500 highs minus the lows. We're still positive when we look at the 5-period moving average of the highs minus the lows across the broad market. And the S&P to utilities ratio continues to go up, and that could often give support to the S&P. So what's our outlook for Tuesday? The technicals are positive, but is weakness developing? And I put a question mark there. Yeah, there's no question, it's developing. It's what kind of a follow-through are we going to see going forward from here? We're not going to have any economic reports on Tuesday, and when we're keeping an eye on all these different geopolitical events. And then in Wednesday's session, we're going to get consumer credit. We get the weekly mortgage applications. And then we're going to get weekly jobless claims, and then there's nothing coming out on Friday. So it's a rather light week with economic reports. So our outlook, we still wonder, is weakness developing? Okay, what's going on here? This is an erroneous slide that I had here, if you want to see what I was saying for Monday's session. Seasonally, we are positive, though. When you go from 2002 to 2022, we are positive across the board with the Dow, S&P, and NASDAQ. We're also positive when we look at this seasonal chart. When we have an up January, that tends to do well for the market. We're also seeing positive here in the 4th year of when the president was reelected or elected the first time. This tends to be positive seasonally. But we do see a little bit of weakness with the Stock Traders Almanac as we get further into February and into March. But this is suggesting that we're seeing some strength in the early part, maybe to the 3rd to halfway through February, before we end up seeing some weakness when the current president is running for re-election. Then this is a newer chart where February is usually weak, especially during an election year. And this just looks at, it goes back to 1950, the past 20 years, the past 10 years, and then the election year, and just shows them all together, where February, as I stated in the last video, the first 6 months tend to be the best of the year, but February is the weakest of the best. And then Tuesday's session, also, when we look at 2023, it tended to be a down day. Here is where we'll be on the 4th trading day of the month, where we do see some negativity when we look at the S&P during an election year. Then the scenarios. We're not going with the down one yet, even though we are seeing weakness starting to develop. We still see more positive things in our charts for right now, but you want to buy into strength, sell into weakness. If we see more weakness, we could be changing over to a negative stance. But for right now, at least the way I look at things, we're not changing. We're not going with the sideways trend because both of our ADX charts are still above 20, even though we're in a weakening trending environment. They both drop below their moving averages. The warning signs, the risk on, it's just chopping around and not helping us. Now, I had to put this back on the warning sign slide. The equity put call ratio based on 5 periods is now going back up. And I put this on the negative slide and the positive slide because we're getting a mixed picture when we look at our S&P 500 oscillators. The McClellan oscillators and summation indexes are negatively diverging, and that's been developing in the short term and also more in the intermediate term. The bullish percent index is declining after being extreme. The transports continue to negatively diverge from the Dow. I'm not showing those charts now. That's longer term. And I'm going to go over those in the weekly video, and I'm just going to mention it here. But if something changes, I will be putting those charts back in the video. The momentum for the NASDAQ 100 is turning negative, but possibly improving, or you could say it's turning positive, but possibly showing weakness. It depends on how you want to look at that. The positive signs, we are seeing growth coming through, and not only just with the S&P, but with the mid caps and the small caps, at least for right now. And then this is the same thing as I said on the warning sign slide about the oscillators, the parabolic SAR, and the vortex charts. They're still positive. The bullish percent index for the NASDAQ 100 is positive, and it's still extreme positive. It's above 70. The Copic curve is positive, and then small and mid-cap growth is positive. It's been chopping sideways. We want to see, are we going to get more follow-through from this to actually show some kind of a breakout? The financial sector, even though it had a down day, is still positive. So our conclusion, we are positive, but is weakness starting to develop? And that's what we're saying pretty much across the short and intermediate term. We're no longer overbought in the long term, but we still remain positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.